First home buyers, you guys have the first half of 2021 to get yourself a good deal. How's it going, guys? My name is Jack and welcome to my channel. Today I want to talk about first home buyers and everything that you need to know to try and make 2021 the year that you purchase your first home. Now obviously purchasing a first home is a bit of a daunting task. It is the biggest financial and physical commitment that you're likely to make at this point in your life. There's just so many different things to consider. Where do you buy? What do you buy? And how much money should you put into this purchase? If you're getting ready to make the most of record low interest rates, then be sure to smash the like button, hit the subscribe button and the notification bell so you know when I post next on this topic. Before you go into any property inspections, it really pays to know your facts, know the process, and understand how much you can afford before you run around, start looking at mansions when you realistically can only afford something a little bit more modest. You also need to understand these three three-letter acronyms in PPR, LMI and LVR. Now if you already know what they are, then you're one step ahead of the rest, but I'll cover them when they come up. Actually, the first one we need to talk about right away, and it is PPR, or your principal place of residence. Now some states call this PPOR, but this really just defeats the purpose of the three-letter acronyms, which make this much more consistent and nice to look at. Now your principal place of residence is the place that you nominate as your main location. So it's the place where your letters get sent to, it's the place that's on your bank statements, it's the place where you have on your driver's license. Now, to be eligible for any of the first home grants and any stamp duty concessions, you have to have this purchase as a PPR purchase for your first home. Not only does the PPR allow you to get free money from the government, but it also avoids any land tax that is charged if your property is considered a non-PPR or investment property. And it also means that you don't have to pay any capital gains tax further down the line when you decide to sell the property. Now buying a house isn't like buying a bag of rice down at your Asian grocery. Even if you found a substantial amount of money tucked in behind your couch, it's most likely that this purchase will consist of two main parts. Part A of your cold hard cash to cover any hard cost, and then part B is the borrowed money which you get from a bank or financial institution to cover the rest. Most lenders now take a 5% deposit as the very minimum, but it will be recommended to put in as much money as you possibly can in and around the 20% deposit mark. If you pay less than a 20% deposit, you'll be charged an LMI, which is the lender's mortgage insurance. Now this is basically just a fee that covers the lender for any mishaps that they may have while lending this money to you, because they are more exposed, having a bigger percentage ownership of the property. The LMI varies depending on how much risk the lender is taking. The bigger the percentage you're borrowing, the higher the cost for the LMI. Another term you'll need to know is the LVR, which, although is called the loan to value ratio, is not really a ratio but a percentage. The LVR is the inverse of your deposit. So if you put in a 10% deposit, then your LVR on this particular purchase is 90%. If the LVR is 80% or less, then you don't have to pay any LMI, and hence the recommendation to put in a 20% deposit for any purchases. As of the making of this video, the big banks are offering the first home owners deposit scheme, which is a scheme that allows a first home purchaser to buy a property with a 5% deposit and not pay any LMI. Outside of the scheme, there's only one way to get rid of LMI, and that is to provide a guarantor for the loan. A guarantor is a secondary entity or individual that is basically the backup payer for any loan defaults. Unfortunately, there's not really a wide array of options because the guarantor basically has to be a parent or a guardian, and can't be just one of your mates, unless if your mate is your guardian. Generally, it's a pretty lengthy process, and it involves them getting all their financials checked as well as putting up some kind of collateral, whether they'll be a fairly large asset or their own house or property. Personally, I wouldn't want to burden someone with this, so I would say aim for a 20% deposit. The other big cost is the big, fat, dirty tax that is stamp duty. Now, stamp duty is 5% of your purchase price, so it's a fairly large chunk of money. Luckily for anyone that's a first home buyer, there is currently a first home buyer's stamp duty concession, which is basically complete exemption from stamp duty under $600,000 and then a sliding scale up to $750,000 within Victoria. Along with the stamp duty concession, you've got the first home owner's grant, you've got the home builder grant, you have developer discounts, and all sorts of things that the government and developers are trying to use to entice people to buy into their real estate market. The other costs worth considering are your legal fees to settle and make the formal transfer of ownership, as well as any moving costs and new furnishing costs, whether they'll be a new couch, bigger TV, or a better rice cooker. The general rule of thumb is if you have saved 30% of your deposit, then you'll have enough money to not only cover 20% of your deposit, your stamp duty, and then all the other costs associated with moving into your new place. Now, the second part we need to look at is your borrowed money, and this is where the fun really begins. Your spending habits is basically your income minus your expenses. If you're like me and live like you're a broke ass uni kid, the lenders will take what is considered a minimum lifestyle requirement. Could be wrong as what that value is, but off the top of my head, I think it was around about $1,800 to $2,000 a month worth of spending that they would basically subtract from your monthly income. Outside of your general living expenses, your borrowing capacity will also be limited by any existing debt that you have, whether they'll be in the form of credit cards, car loans, student loans, or anything that basically sucks money out of your account. So basically the lender will look at realistically what you can afford to borrow, how much you can pay back, whilst maintaining your current lifestyle. Now, the first step to get an idea of how much you can borrow is to use one of the online calculators that any of the big banks provide. My personal favorite is the NAB one because you can make adjustments very quickly with it. I've linked that in the description below for your access. But the formal pre-approval process is a bit more complicated and is what you need if you want a formal pre-approval in writing of how much you can borrow and what you can buy. To get a pre-approval, you can go through one of two avenues. You can go through directly with the financial institution, whether that's a bank or a private lender or some other financial institution, or you could go through a broker. Now, there's pros and cons in either way, and I want to just quickly talk about why you would go for one over the other. If you are intending to use the bank that you currently bank with to get the mortgage, then there's a lot of bank statements you don't actually need to produce because they have access to it within their system. Now, I personally hate downloading statements and then sending it across, so for me that's a fairly big plus. A con, and a very big con, is that banks are very monogamous. They're not too interested in you trying to get multiple pre-approvals from different parties. As a matter of fact, say if you go through the process of getting a pre-approval with Bank A, and you realize halfway through the process that Bank B actually has a better deal, the only way to even start the application process with Bank B is to terminate your current application with Bank A and then go through the process right from scratch all over again. One thing to highlight here is every time you put through an application, there will be a credit check against your credit file. You don't want too many credit checks because what that would suggest is that you've gone to get a pre-approval and for whatever reason have been rejected. So you've gone to your second option and then your third option. Basically, a lender will assume that you're either being too promiscuous or you're just a dropkick that don't have your finances sorted and can't get a loan from any of these previous applications. With the broker, on the other hand, you can put in one application and the broker will suggest anywhere between 2 to 3 of what they consider the best options for you. A good broker will find a lender with all the bells and whistles that you would want in a home loan, as well as the best rate that they can get you. Most of the time, these will be deals that you don't even know exist and aren't advertised anywhere on TV or online. A pre-approval is valid for 3 to 6 months, and it is subject to your finances being consistent throughout the whole process between your pre-approval and signing of your contract. And it assumes that your lifestyle is more or less the same throughout. Now, one thing you do need to watch out for with any pre-approval is that it is usually subject to the valuation of the property you purchase. A lot of the times the lender would have a LVR nominated for the amount that they're happy to lend you. And that LVR is based on the valuation of the property that you end up purchasing. Say you get a pre-approval for a $600,000 purchase at an 80% LVR, and you see a place that you like, end up purchasing it. The bank will then make an assessment as to what they think the property is worth, and if the property, say for whatever reason, comes back at $560, based on the 80% LVR, they would only lend you $448K, and therefore as a purchaser you need to make up the difference of the $32,000 that's a shortfall. However, interestingly, this is not the case if you go to an auction and purchase a property at auction. A property purchased at auction is considered to be true to value at the purchase price. The good news is once you have your pre-approval, you basically are financially market ready to go out there and have a look at what's out on the market. With record low interest rates, government handouts, and an oversupply of rental property causing investors not to come into the market, this is the best opportunity for first home owners to get their foot in the door. Basically, my suggestions for anyone looking to buy their first home is to get all their finances sorted, get a pre-approval, as well as do some research on which grants and schemes that you are eligible for, and try and get something within the next 6 months before international travel opens back up, and there will be more demand for property both in the first home owners that have missed out for the last couple of months, as well as investors who are now back in the market. Now, if this was helpful for you, please consider subscribing. It helps me a lot if you guys smash the like button, and let me know if there's any other comments or any other questions that you may have. So, no real pressure, but first home owners, you guys basically have 6 months to try and get the best deal you possibly can. So, good luck.